In this chapter, we're going to talk about cost volume profit analysis. So let's go ahead and jump right in. It is important to manage costs. We have the example here of GoPro. Those are the cameras that are used by adventure seekers, hikers, drivers, etc. And this notes that they gather information about market demand and they try to focus on higher margin products. And it says that they've done this by considering and understanding the economic consequences of cost structure, fixed versus variable costs, contribution margin, and break even. And so we can see how that's helped them. We call this analysis cost volume profit analysis, and that really means working to learn, understand, use, apply information about costs and profits and how they vary with varying levels of business activity. And so this can be applied product by product, company by company, segment by segment, division by division to really understand those costs. So what type of questions do cost volume profit and analysis answer or address? They address things like what level of sales must be reached to cover all expenses or to break even, where revenue exactly equals costs. A lot of times when a new product is imagined and developed, we want to see if we can at least break even. We also want to know, hey, how many units do we need to sell to get a specific level of income? And what happens if we sell more? How much will profitability increase? What if we changed compensation from fixed monthly salaries to essentially getting a commission for the salespeople? So these are the types of questions that cost value profit analysis helps us address. So let's talk for a minute about an example here. McKinley Airlines. Let's imagine that they are a small charter service and assume the monthly cost of operating the airline is $66,000. Airlines often consider passenger miles. That's usually a significant cost driver. And so it's often used and will be used in our case where we're studying the behavior of cost. Okay, since we've identified passenger miles as an appropriate activity-based, now we need to classify each of the airline's operating costs into three broad categories. So we'll start with fixed and then variable and then semi-variable costs. So fixed costs are those costs and expenses that do not change significantly in response to changes in activity base. So the example might be depreciation expense. Okay, so the monthly depreciation expense does not vary with the number of passenger miles flown. Okay, so there's a number of these items in a company, like rent, whether you use the building or you don't use the building at all, it's going to cost the same. How about insurance? Certain salaries often would be fixed as well. So that's an example of fixed. Don't vary. Do not change significantly in response to changes in activity base. In this case, we've chosen number of passenger miles as our activity base. The next one is variable cost. So variable cost suggests, hey, the more passenger miles, hey, the more costs. So total variable cost is one whose total rises or falls in approximate proportion to changes in the activity base. So if we fly more passenger miles, there's going to be more spent on fuel. So if passenger miles were increased by 10% in a month, we would expect fuel expense to increase by 10% per month. Okay. Then there's area kind of in between. So semi-variable costs are sometimes called mixed cost. The monthly fee McKinley pays to Fairbanks Airport is a good example. Okay, so there's a fixed base rate just because they are there at the airport. And then there's an added charge for each passenger mile flown. And so you can see that. So the fixed portion relates to the rental of the hangar space. Okay. The variable portion relates to the airline's use of the passenger terminal. So you can see there's components of both a mixed cost here. So let's look at it specifically for McKinley Airlines, where we see here are their fixed costs, here are their variable costs, the fuel and maintenance, and here is the mixed or semi-variable cost. So you can see what that looks like. Now we're going to translate this into some graphs and see what they look like. So the first one, 39,000, where'd that come from? Well, here's adding up these three, 39,000. So regardless of how many passenger miles, same fixed cost. Okay, how about passenger miles? Well, if we have 400,000 miles, so it's 400,000 miles times 8 cents, so that would be 32,000. 200,000 times 8 cents, 16,000. So you can see how those change. And then the same here with the semi-variable cost. 3,000 is our portion, and I'll go back one. So 3,000 per month, and then 2 cents per passenger mile. And so you can see what that looks like. Now, if we were to combine these three graphs together, and we'd see here's the level of fixed cost, that's 39,000. If you add the 3,000 component coming from semi-variable costs, that would be this line, and then that would increase. And then that now add on top the variable costs, and you can see those total costs for assuming 400,000 miles. So you can see how costs vary with respect to the activity base, which is passenger miles. And we can also see that here. So here's the detail of what we just ran. And it's got the variable, it's got the fixed, and it's got the semi-variable. And you can see the cost per passenger mile decreases because the fixed costs stay the same. So if we do 200,000, then it's going to have a certain cost. But 39,000 divided by 400,000 is a much lower cost. And so we look at that and we see that the cost per passenger mile, we see that that is decreasing. Why is it decreasing? Because we're spreading those fixed costs over more passenger miles. So you can see that. Now, it is important to differentiate between the behavior of total costs versus the behavior of per unit costs. So here's my per unit, here's total costs. Okay, so let's start here. Notice we're in the variable cost column here. The per unit cost for variable costs stays the same. Okay, doesn't matter if volume increases, doesn't matter if volume decreases, it stays the same. But because we have a variable cost that matters, that varies with respect to volume, so total will increase. So if we did more passenger miles, guess what? More costs. Less passenger miles, less costs. All right, now let's see how that differs with respect to fixed cost. Per unit, if volume increases, that will decrease. We saw that on here, right? We saw that that would decrease. But per unit, if the volume decreases, then the cost per unit is going to increase. So if we've gone this direction, we're going to see the per unit cost or cost per mile will increase, and that's here. But in total cost stays the same regardless. So sometimes it's important, easily to get confused on, what a change in volume will do. Okay, so that's something to kind of think about and figure out. So economies of scale, that refers to the reduction in unit costs by using companies' productive assets more efficiently. Okay, and that's because, so fixed costs are 8.4 million per month, and we can produce up to 7,000 automobiles. So whether we produce 4,000 or 7,000, you can see the cost per car will decrease. And that's due to economies of scale. Okay, we're going to use that plant more efficiently and produce more cars, and that makes the fixed cost per unit fall. Well, where do we see these economies of scale? Well, airlines, oil refineries, steel mills, utility companies, these typically have a high level of fixed costs. So if we can use those facilities more efficiently or more intensively, then we're able to lower the fixed cost per unit. So Southwest Airlines is an example. Many airlines, including some of the nation's largest, have been losing money in recent years, but several smaller airlines are doing better than the larger competitors. Why? Because they are operating at or near full capacity. Okay, what is the cost of the fixed cost associated with airlines? Well, they've got to rent their plane, and regardless of usage, the fixed cost is going to be the same. So they're going to work to be very efficient and fill more seats as they go. Okay, so let's talk a little bit more about additional cost behaviors. Rarely do costs fit exactly into fixed or variable or even semi-variable. They're often going to look different, like there's going to be a step function, or it's going to be curvy or something like that. And so we recognize that as something we need to consider. So with all these variations of cost behavior, it's important to understand how cost behavior works. So unusual patterns of cost behavior are most likely to occur at extremely high or extremely low levels of volume. For example, if output were increased to near 100%, the variable cost would curve sharply upward because of payments for overtime. Okay, so if we're at or near 100%, we're going to be paying a lot of overtime. Or an extreme decline in volume. Okay, what if we shut down a plant or have an extensive layoff? There's going to be additional charges associated with that. And so we're going to see those. So most businesses operate somewhere between 45 and 80% of capacity, and we call this typically the relevant range. And so the relevant range says if we're here between 45 and 80%, that starts looking variable. But if you start going outside of the relevant range, then those would change. Okay, so we just recognize that as cost behavior, and oftentimes we'll say, hey, as long as we're in the relevant range, right? So let's talk about cost behavior and operating income. Okay, how does operating income computed? Well, it's going to be the revenue less variable costs less fixed costs, and we'll just throw in here, the semi-variable costs as well. But for simplicity, we're just going to break this down into variable and fixed costs. Okay, so revenue less these costs equal operating income. And so we're going to use cost volume profit analysis to determine break-even level and how profits change as these costs change. So the break-even point is going to be the level of activity where operating income is exactly equal to zero. And that's usually our starting point, is where's break-even and what happens if we lower costs, change costs from variable to fixed, and so forth. Okay, so we see that. As we talk about cost volume profit, we want to carefully define profit. Note this is operating income, not net income. Why? Well, there are a number of things like income taxes, non-operating gains and losses, interest expense, for example, would all be included in net income. But those aren't really relevant to us. We want to know how it changes with respect to our main operation, what we do. So our operating income, not our non-operating components. That's kind of separately managed. So cost volume profit analysis contains very little information about cash flows. Okay, so we're looking at the impact on income rather than the impact on cash. Usually it's both, but we're trying to make that distinction here. All right, so we're going to use as an example Snowglide Company. They manufacture snowboards. They sell in Colorado, Washington, Oregon. Because of popularity, they're thinking about distributing at several East Coast Wholesalers, although wholesale prices vary depending on the quantity of boards produced by a distributor, revenue consistently averages $90 per board. So that's going to be our revenue figure. So look here at the top. Okay, here's our $90. And here are our variable expenses. Here are our fixed expenses. And we have something that we'll continue to talk about, which is our contribution margin. Now notice this is our per unit. So these are per unit costs, at least till we get down here, per unit. And here is the percentage of the price. And so these are in percents. Okay, so we have both our variable as well as our fixed costs. So let's look at this and see how it might look like on a graph. And so here is our, first of all, let's talk about our revenue line. Okay, if we sell no products, we have no revenue. And we're going to make $90 for each one. So if I take 150 multiplied by 90, I see this 135,000. Okay. The next one, let's look at this green line. All right. So this green line here is fixed cost, 37,800. So let's see if we can see that on the last slide. Here's 37,800. That's our fixed cost. Okay. Now we have our variable costs, and our variable cost per unit is how much? We decide our variable cost per unit is $36. And so this is going to increase at $36 per snowboard sold. Okay, so let's look real quick. Where's the break-even point? Where does this total cost line? So remember, this is variable costs plus fixed costs. So here's our total cost, and notice where it intersects with the revenue line right here. And we can see, hey, if we sell above this, here's the profit we can make. If we sell below this, here's going to be our loss. And so remember, this is operating income. It says down here, profit and loss represent income or loss before income taxes, or we'll just define that as operating income. All right, the next thing we want to talk about is contribution margin. So contribution margin is revenue less variable costs. We can do it on a per unit basis. So the unit selling price, less the variable cost per unit. So let's go back and look at this as revenues less variable costs. So we're going to go back 2 slides here. 90 less the variable costs is going to be a unit contribution margin of $54. Okay. And now it says, what's the contribution margin? Well, the contribution margin ratio will be 54 divided by 90, or 60%. So we can see that included there. And that was our next computation, is what's the contribution margin per unit? That was $36 divided by sales price, $90. And that gives us a contribution margin of 60%. Okay, so let's see what's next after considering contribution margin. All right, so here's our 90 less 36 equals 54, and it's 60%. So we see what that looks like in terms of variable expenses. Okay. So the concept of contribution margin helps us determine our unit sales volume required for a business to break even. And there's some ratios we can use, some formulas we can use to determine the break-even sales volume. So let's do that here for Snow Globe. So here's the sales volume, and the sales volume is going to be fixed costs divided by $54 per unit. Okay, so if we sell 700 units per month, we're going to break even. So let's go back here to our graph, and here's 700, and that's where we break even. Okay, so we can see how that all kind of comes together there. All right, but let's say we want to make a target operating income, like we want to hit a certain threshold with this. And let's say, hey, we want a monthly operating income of $5,400. We're going to take our fixed costs here, $37,800, our desired target operating income of $5,400, and we're going to divide that by the contribution margin per unit, or 800 units. All right, so let's go back to our graph here and see if we can see that. Well, kind of hard to see exactly there, but if we were here at 800, this would be where we'd make the $5,400. Okay, so we can see that in there. And using these formulas help us see that. Okay, So that's how many units we need to sell. All right. How many dollars in sales? So notice this was in units. And now we're going to do it in terms of dollars. And now instead of using the contribution margin per ratio, we're going to use the contribution margin, instead of using the contribution margin per unit, we're going to use the contribution margin ratio, which we determined was 60%. So again, here's my fixed cost, $37,800. Here's my target operating income for $5,400. I'm going to take all that, divide by 60%, and say I need to have sales volume of 72,000. Okay, so I can see that there. All right, what is our margin of safety? So let's define margin of safety first. The margin of safety is the actual sales volume, the amount by which the actual exceeds break even. Okay, so it also represents the dollar amount by which sales can decline before an operating loss is incurred. So it's kind of where we're in the safe zone. So let's see if we can figure that out. So the first thing we're going to do is figure out the sales volume required to break even. This is our fixed costs. Notice I don't have my margin of safety I don't have my target in there. Okay, but at 37,800 divided by 60%, so 63,000 per month. Okay, and we have monthly sales of 73,000. So the margin of safety for that month is 73,000 less the break-even level of sales volume of 63,000. And so we can see what that looks like. Okay, so we can go a little bit further and say, how big of a margin of safety do you want? And multiply that by the contribution margin ratio. And that will help us quickly determine our estimated operating income at any projected sales level. Okay, so cost volume profit is not just used by accountants. It's used by essentially all decision makers, or at least ways to think about it. So, as previously mentioned, the popularity of snowboarding has prompted Snow Globe to consider distribution. Okay, so different managers within the company will naturally have different yet interrelated planning concerns regarding the implementation of the strategy. So assume that Snow Globe is currently selling 900 snowboards. In response to the new market strategy, the company's director of advertising says, hey, costs are going to increase $1,500 in the monthly budget. She plans to use these funds to advertise in the East Coast. From her experience, she is confident that the advertisements will result in monthly orders of 500 more boards. So they were at 900, and we think we can sell 500 more. So she wishes to emphasize the impact of her request on the company's operating income. So let's see what that looks like. All right, we're going to start by calculating the company's current monthly income based on current sales of 900. And then we'll go the step further and figure out what it would be if we sold 1,400. So here's 900 at $90. That's the cost per board. Remember, the variable costs are 40% and the monthly fixed costs are 37,800. So the current monthly operating income at 900 units is 10,800. Okay. So as the proposed advertising is viewed as a fixed cost, this expenditure does not affect Snow Glide's contribution margin ratio of 60%. Okay. It doesn't affect the variable cost. Based on projected monthly sales of 126,000, that's the 1,400. Remember, 900 plus the 500 at $90. All right, this is what it would look like. What the fixed costs are 39,300. Remember, that's let's just find that again. It was 37,800 plus the 1,500, so that's 39,300. We expect projected sales of 126,000. We have our contribution margin of 60%. And now the projected operating income would be 36,300. Okay. So the target income figure is 25,500 more than what it had been in the past. So 36,300 less our base case of 10,800. And so we can see that there. So the director of advertising believes that her request for an additional $1,500 is well justified. And we can see that by the projected operating income. Okay. Well, not surprising, the plant manager says, I think increased demand will put pressure on the plant's production capabilities. To cope with the pressure, he asserts that many factory workers will now be required to work overtime, and that will cause an increase in the direct labor of approximately $1.80 per unit. Assuming that he is correct, he wants to know the sales volume in units required to achieve the advertising director's projected monthly income figure of $36,300. And so we're going to figure out how many more we're going to have to sell to get the $36,300 if labor costs increase. Now, the first thing we're going to note is that's going to increase variable costs. Okay, so let's see where that shows up. Okay, so it was $36. It's going to increase here to $1.80. And so now the contribution margin is $52.20. And so if we want to figure out our projected amount of sales in units, we'll take this fixed cost, $39,300, right? That includes the advertising, plus the $36,300. That's our target operating income, and divide by 5250. So you can see how 5220 to get 1448 units per month. So you can see how we can use various what if scenarios to answer these questions, right? And so say, okay, but it's going to cost us more. So how do we still get to 36,300? Well, we're going to have to sell 1448. Whereas before we said, hey, we just need to sell 1,400 units, and say, well, actually, because of a reduced contribution margin due to the increased variable costs, now we've got to sell 1,448 to get to this target operating income. Okay. Now, assume you are the plant accountant and you have a budget fixed overhead of $2,800 per month for production level at normal capacity of 1,000 units per month. Thus, your overhead application rate has been set at 20,800 divided by 1,000. You realize that a production increase now to 1,500 will result in over-applying fixed overhead to the tune of 10,400 per month. Okay. So note what this looks like. You realize that a production increase to 1,500 units per month will result in over-applying fixed overhead. Okay, and you're hesitant to bring up the problem of the overhead application rate with the plant manager because both you receive a yearly bonus. If overhead is being over-applied because production is now at 1,500, the application rate is too high. If the projected sales volume of $1,500 does not occur, then many of these fixed costs are going to be assigned to unsold inventories. That will make income larger and your bonus to be larger as well. So what do? Well, you want truth to be truth, right? You want to not just do something for your bonus. You want to apply it at the correct rate. Now, you've got a plan, and you can't just do everything on projected. You've got to see what actually does occur. And so that would be the question. Okay, so let's continue here. Vice President of Sales is convinced that an increase in the monthly advertising of 1,500 will actually produce 500 units. And so our estimate is more conservative at 350. So monthly advertising is 1,500 and the direct labor does actually increase. All right, what does that mean? If the Vice President of Sales is correct regarding her 1,250 unit projection, she wants to know the extent to which the company would have to raise its selling prices to still achieve that 36,300. So this is another what-if scenario. Okay, it wants to know the extent to which the company would have to raise its selling prices. So let's go and look. If 1,250 units are sold instead of 1,400 units, the contribution margin per unit must increase in order for the company to achieve the same target margin. So if we have 1,250 units, the fixed cost is still 39,300. We're still trying to get to the 36,300, and we're trying to figure out and solve for this contribution margin per unit. If you recall, you can swap these two. So contribution margin per unit would be $60.48. So if our unit selling price is something we need to calculate, right? So we want a contribution margin. Remember, contribution margin is the unit selling price less the variable cost per unit. And so we're going to solve for unit selling price and say that's got to be $98.28. So you can see how we can do this what if analysis based on different scenarios. But we recognize that this cost volume profit requires certain assumptions. For example, you may sell more than just snowboards, and different products will have different contribution margins. There's also going to be some semi-variable costs, and we need to check all these and make sure they make sense. All right, so what happens if a company sells many products? Well, there's going to be a product or a sales mix, and that's going to be relative percentage of total sales provided by different products. Each product has a different contribution margin ratio, and so managers will often use an average contribution margin ratio and weight it by the percentage of sales. So let's see what that might look like. So now our Snow Glide also sells goggles, okay? And contribution margin ratio for the two product lines for snowboards, as we've been discussing, is 60%, but goggles, it's 80%. But snowboards represent 90% of the sales, and goggles the other 10%. So you can see if we look at it this way, we're going to have an average contribution margin ratio of 62%. Okay. Now let's spend a minute and talk about semi-variable costs. And semi-variable costs have both a fixed and a variable portion. And we need to estimate our components of fixed and variable costs. There's multiple methods we can use. Probably the easiest would be the high-low method. Okay, so we have the high-low method, and we can say, okay, assume some portion of Snow Glide's total administrative cost is fixed, and some portion varies with the level of production. All right, so here are our production and administrative costs for the first 6 months of the year. So here's how many we produced. Here's our total administrative expenses. So we want to find the variable portion of this. And so we're going to go ahead and relate and take the highest and the lowest. Okay, and let's go ahead and look at that. So the highest here looks to be April. The lowest looks to be February, $950, $850. And those relevant costs for those 2 months suggests that the difference is $240. So $240 in that 100 would be 240 divided by 100, or 240 per unit. And so we can see what that might look like. And once we know the variable costs, then we can go and work to compute the total fixed cost. So if our total cost is $25,280, so let's go and find that. That's for April, $25,280. And it's $2.40 per unit for the 950 units produced that month. And that suggests the fixed cost would be $23,000 per month. So that helps us determine the level of fixed as well as the variable component. Now that we have this formula, we can use it to evaluate the reasonableness of administrative costs, and it also helps us forecast what costs might be in the future. Okay, so if the monthly fixed cost is 23, then if we produce 930 a certain month, we would expect the administrative cost to be 25,232. All right, next is let's look at the assumptions. All right, for cost volume profit analysis. Okay, so we assume the sales price will be remain constant, that we're able to use a sales mix because we have various products, that the fixed costs stay within the relevant range. That's not going to change if volume goes up. The variable cost will remain constant. Okay, so it stays within the relevant range. And manufacturing companies, the number of units produced is equal to the number of units sold each period. Okay, so that's just some assumptions we're making. And if these assumptions don't make sense, then we're going to have to change. We can't really use cost volume profit. We have to use some assumptions. So sometimes you're going to use averages. Sometimes you're going to sometimes you're just going to take this as given and recognize it might not work perfect in every situation. So we've talked about a number of mathematical relationships, and so this is just kind of a summary of that included here.